focused on the US, but I think Europe is in a recession. China, some of the numbers coming out of China are shocking as well. That has an impact on the rest of Asia. So what they're facing is a recession, and their currencies are dropping. Their currencies are dropping relative to the dollar, which means their purchasing power is going down. But it also means that some of them are tightening more because their currencies are falling against the dollar. So it's a bit of a vicious cycle. And as Nancy says, I agree with you, Nancy, we are not alone. Many people are thinking about the U.S. in isolation. We've already had 1/4 of negative GDP, which most people brushed aside, saying, "Oh, that's a fluke." And I think that was a real number, and we should not dismiss it. As you know, everyone looks at the same data. We all get the same data. The government puts it out. But different economists place different emphasis on certain variables at certain points in the cycle. And so we were watching 2 points of view based on the same data. One was we are back in the 70s environment. Inflation is baked into the cake. It's going to be very difficult to dislodge it. And we're probably in an environment where commodity prices, real estate, tangible assets generally are going to do much better than the financial markets. And so we were dealing with that scenario. And as you know, we were looking at data, and actually more than a year ago anticipated a very different world. What we didn't anticipate, of course, was the extent and the length of time that we were going to see supply chain disruptions. And we certainly did not expect Russia's invasion of Ukraine. So those have been variables, we've had to work through in terms of our own thinking about the future. But we did come to the same conclusion. That we were probably going to see more deflationary forces at the end of all of this than inflationary forces. And I believe that we are in the early stages of seeing that. In past cycles, many people thought that the dollar going up was the same as monetary tightening. It's a disinflationary force. And it's up 15% since the bottom, which is a huge increase for the dollar in such a short period of time, and really hurts emerging markets. That those who are listening will say, "Oh my gosh, this is terrible," and it is in one way. But one of the things we're focused on is what will get the Fed to stop tightening, or at least change its rhetoric. And I think as these forces put pressure on the economy, and you get companies like Walmart and Target reporting terrible numbers from 2 points of view, and I know Nancy is going to go into some of this, but their sales up 3% year over year, while inflation itself is up. If you looked at CPI, 8%. Now, they're not passing all of that through, but I am sure that they are passing more than 3% through. So that means their unit sales, their real sales, are declining on a year-over-year basis, while inventories are ballooning. And we think that those two factors, and now the Fed must be aware of them because Walmart's such a big, and Target's such big companies, those two factors probably have gotten the Fed thinking, my goodness, are we overdoing it here? The Fed is really focused on the U.S., but